We often stand at the edge of uncertainty, don't we? The air thickens with whispers of what might be, and the financial world, in particular, seems to thrive on ambiguity. Headlines scream about impending downturns, painting a picture of a singular, cataclysmic event. This external noise, this vague forecast, often paralyzes us. We find ourselves either frozen, unable to act for fear of the unknown, or worse, reacting impulsively, driven by a primal fear that rarely serves our long-term prosperity. It's a common human tendency to seek a simple, definitive answer, a single voice to guide us through the storm. But is that truly how the intricate mechanisms of the market, or indeed life itself, operate? Benjamin Graham, the father of value investing, understood this deeply. He taught us the profound importance of a margin of safety, not just in our investments, but in our understanding. He knew that true financial wisdom wasn't about predicting the future with absolute certainty, a fool's errand, but about building a robust framework of knowledge that allows us to navigate whatever comes our way. This framework, this margin of understanding, comes from dissecting the raw data, from looking beyond the pronouncements and interpretations, and seeing the fundamental truths for ourselves. Recessions, like many complex phenomena, are not a single, deafening clap of thunder. They are a symphony of data points, a confluence of rhythms, each with its own cadence, its own story to tell. To rely on a singular forecast is like listening to only one instrument in an orchestra and expecting to understand the entire composition. It's incomplete and often misleading. This is precisely why we're here today. We're going to move beyond the headlines, beyond the generalized anxieties. We will equip ourselves with a clearer lens, a more discerning ear. We will uncover for specific data points, tangible signals that resonate with the underlying reality of the economic landscape. These are not abstract theories. They are concrete indicators that can transform our apprehension into informed strategy, our fear into foresight. This is about building your personal margin of understanding so that when the winds of change blow, you are not merely tossed about, but are ready to steer your course with confidence and clarity. Is your current approach to market uncertainty built on a solid foundation of data, or on the shifting sands of speculation? Let us begin by examining the first crucial data point, the inverted yield curve. This isn't just an abstract financial concept. It's often referred to as the market's verdict on future economic growth. To understand it, we need to grasp what bond yields, particularly those of government treasuries, truly represent. When you buy a bond, you're essentially lending money to an entity, and the yield is the return you expect for that loan. Typically, longer-term loans carry higher interest rates, or yields, because there's more risk and uncertainty over a longer period. This is a normal yield curve, reflecting an expectation of economic expansion. However, sometimes this dynamic flips. When short-term bond yields become higher than long-term yields, we call this an inversion. Think of the yield curve as a doctor's temperature reading for the economy. A normal curve with higher long-term yields is like a healthy, steady body temperature. An inverted curve, where short-term rates exceed long-term ones, is a sign of systemic distress. The market, in essence, is signaling that it believes immediate conditions are less attractive than expected future conditions. Investors are willing to accept a lower return for locking their money away for longer periods, anticipating a future economic slowdown or recession where rates will likely fall. Now, it's vital to acknowledge that while historically a strong predictor, an inverted yield curve isn't a flawless crystal ball. The lead time between inversion and a recession can vary, and other economic factors can influence the outcome. This is why we must never rely on a single indicator. It's the corroboration, the symphony of data, that provides true insight. So, what's actionable here? We need to track the spread between specific treasury yields. For instance, the 10-year treasury yield versus the 3-month or 2-year yield. A sustained inversion, not just a fleeting dip, carries significant weight. It often signals that sectors heavily reliant on future growth, like technology or consumer discretionary, might face headwinds. Remember, the true verdict isn't just the inversion itself, but its duration and depth. How long has this fever persisted, and how high has it climbed? This sustained signal tells a more profound story than a momentary blip. Our second critical signal is rooted in the very pulse of economic activity, consumer confidence and spending. This is the engine of our economy, and consumer sentiment acts as its fuel gauge. When people feel secure about their jobs and their financial future, they tend to spend. They buy homes, cars, and the myriad of goods and services that keep businesses running and profits flowing. This free-flowing spending is the high reading on the fuel gauge, powering a robust economic engine. Conversely, when confidence wavers, when uncertainty creeps in about job security or the rising cost of living, that fuel gauge starts to dip. Consumers become more cautious, their spending slows, and the economic engine begins to sputter. It's a direct correlation. Shifts in how people feel about their economic prospects have a profound and immediate impact on demand and consequently on corporate earnings. However, there's a hidden trap in relying solely on past spending data. Consumers are not passive observers. observers. They are active participants who react to news and sentiment. A sharp decline in consumer confidence, even if past spending figures still look relatively stable, is a powerful forward-looking indicator. It tells us that the fuel is about to run low, even if the engine is still chugging along for now. We must look at these sentiment indicators with the same, if not greater, weight than historical spending figures. To track this vital signal, we should monitor key reports. The Conference Board's Consumer Confidence Index, for example, provides a detailed look at how consumers feel about current and future business conditions, employment, and income. Alongside this, the US Census Bureau's retail sales reports give us concrete data on actual spending patterns. It's crucial to understand how sentiment regarding jobs and business conditions translates into actual spending, particularly for big-ticket items like durable goods versus everyday necessities. Beyond the headline numbers, delve into the subcomponents of confidence surveys. Are people worried about job security? Are inflation fears dominating their outlook? Understanding where the real pain or resilience lies within consumer sentiment provides a far more nuanced and reliable picture. Is the fuel gauge truly low or just flickering? Our third vital signal comes from the very heartbeat of business activity, manufacturing and industrial production. This sector forms the bedrock of economic output, producing the tangible goods that fuel our lives and industries. Metrics like the Purchasing Managers Index, or PMI, and figures on industrial production offer a clear window into the health of this foundational component. Think of industrial production as the economy's heartbeat. A strong, steady, and consistent rhythm signifies robust activity, a sign that the economic body is functioning well. Conversely, a faltering, irregular rhythm indicates stress, a slowing circulation that can have far-reaching consequences throughout the entire business landscape. When factories are humming, producing goods, it stimulates demand for raw materials, creates jobs, and drives investment. There's an overlooked risk here. It's easy to be lulled into a false sense of security by growth in the service sector. While services are a significant part of modern economies, a slowdown in manufacturing can be masked by continued service sector strength. This can lead investors to mistakenly believe the overall economy is healthier than it truly is, ignoring the creeping weakness in the industrial heartland. This weakness often has significant ripple effects on employment, demand for raw materials, and ultimately broader economic health. To gain actionable insight, we must closely monitor the ISM Manufacturing PMI, paying particular attention to its key components like new orders and employment. The Federal Reserve's Industrial Production Index provides another crucial perspective. A PMI reading below 50, for instance, is a widely accepted signal of contraction in the manufacturing sector. It's a clear indication that the pace of production is slowing. Crucially, the new orders component within the PMI acts as a leading indicator. It's like an early pulse check, offering a glimpse into future manufacturing activity. If new orders are declining, it suggests that factories will soon be producing less, even if current production levels still appear stable. Ignoring this segment is like ignoring a faint pulse when assessing overall health. Is the heartbeat of industry steady, or is it showing signs of strain? Our fourth and final key data point is the leading economic index, or LAE composite. This is, in essence, the economy's weather forecast. Unlike a single barometer reading, the LAE synthesizes 10 different forward-looking indicators, weaving them together to provide a more comprehensive prediction of the economy's future direction. It's a sophisticated construct designed to synthesize multiple atmospheric readings, various economic data points, to predict whether we're heading for sunny skies of continued growth or the stormy weather of a potential recession. The danger, however, lies in an oversimplified approach. Many investors fixate on just one or two components of the LAE, such as manufacturing orders or building permits, and miss the cumulative, more powerful signal. This is akin to a meteorologist focusing only on wind speed and ignoring humidity and pressure changes. A decline in the overall composite index, particularly when it persists over several months, is a far more robust warning sign than isolated shifts in individual components. It's the consistent pattern, the sustained trend, that truly matters. So, what's the actionable insight here? Regularly reviewing the Conference Board's LAE release is essential. Pay close attention to the percentage change month over month, and crucially, note the total number of consecutive months the index has been in decline. Historically, sustained downturns in the LAE have shown a strong correlation with subsequent recessions. While no economic indicator is infallible, the LAE, when understood deeply and not reduced to its constituent parts, offers a more nuanced and data-driven prediction than mere guesswork or emotional response. It provides a sophisticated lens through which to view the economic climate, helping us prepare for the approaching weather, whatever it may be. Does your current economic outlook rely on a single reading or a synthesized forecast? We've explored for distinct yet interconnected data points the inverted yield curve, consumer sentiment, manufacturing activity, and the leading economic indicators. Now, the true art of financial mastery lies not in treating each of these as isolated pronouncements, but in synthesizing them. No single indicator, however potent, is a crystal ball. A holistic, data-driven approach, where these signals are viewed in concert, is paramount for navigating the complexities of market downturns. Imagine you are captaining a ship, preparing to sail through potentially turbulent seas. Each data point we've discussed is a crucial component of your vessel and its instruments. The inverted yield curve is like the hull, indicating the underlying structural integrity and future expectations. Consumer spending is the engine, providing the power and momentum. Manufacturing data acts as the navigation system, charting the course of business activity, and the lay composite. That's your sophisticated weather instrumentation, providing the most integrated forecast. For safe passage, each must function, and crucially, each must be understood in relation to the others. The psychological trap many fall into is either ignoring these signals out of a fear of missing out on potential market gains, or panicking and making rash decisions when downturns appear imminent. This is where data becomes our rational anchor. It provides an objective grounding, a counterpoint to the emotional tides that can so easily sweep us off course. So, what's the actionable strategy? It's about building a recession readiness checklist. Informed by these indicators, define your personal thresholds. What level of sustained yield curve inversion or decline in consumer confidence prompts you to reevaluate your portfolio allocation? When might it be prudent to increase cash reserves or consider more defensive assets? This isn't about perfect prediction, it's about diligent preparation. True financial mastery, much like a seasoned captain navigating by the stars rather than just the visible horizon, is about building a resilient portfolio capable of weathering any economic climate through a rigorous understanding of the underlying data. Are you building your ship with all the necessary components? We've journeyed beyond the sensational headlines and the whispers of fear, delving into the concrete signals that truly matter when navigating economic uncertainty. We've dissected for critical data points, the telling inversion of the yield curve, the vital pulse of consumer confidence and spending, the foundational rhythm of manufacturing and industrial production, and the synthesizing power of the leading economic index. These are not mere abstract numbers. They are reflections of deep economic forces and, fundamentally, of human behavior and expectations. Think of these signals as the wisdom of the ages, distilled into actionable insights. They echo the timeless advice of figures like Benjamin Graham, who urged us to understand the intrinsic value and build margins of safety, and Warren Buffett, with his simple yet profound rules. Rule No. 1. Never lose money. Rule No. 2. Never forget Rule No. 1. These data points are your most effective tools for adhering to those rules, for protecting your capital when the economic seas become turbulent. They provide a rational anchor, allowing you to steer clear of the emotional storms that so often wreck investment plans. By integrating this data-driven approach into your own investment process, you transform anxiety into clarity and uncertainty into opportunity. It's about moving from a reactive stance, swayed by the emotional winds of the market, to a proactive one, guided by the steady light of empirical evidence. This is the path to building not just wealth, but true financial resilience, a portfolio that can withstand the inevitable cycles of the economy, not through luck, but through informed, strategic decision-making. As you move forward, commit to observing these indicators, to understanding their interplay, and to letting them inform your choices. The goal is not to perfectly predict the future, for that remains an elusive pursuit. Instead, it is to build a robust understanding that empowers you to act with conviction, to safeguard your financial future, and to emerge stronger from any economic climate. How will you use this data to guide your next move?